Customer Segmentation in Banks. Hello and welcome back to our series on banking for everyone. Here we try to make banking simple, useful and honestly a little more human for you all. I'm really glad you have tuned in today because we are tackling something that works quietly behind the scenes for every banking strategy, and yet most people have never heard of it. We are talking about customer segmentation. Now, before your eyes glaze over, stick with me because this is not just a corporate buzzword. It's actually a reason a farmer in rural Rajasthan can get a loan, why a housewife in a small town gets a savings product which is just designed for her, and why sometimes a bank advertisement that feels like that it was just made for you specifically. So let's get into it. Now, what is customer segmentation? Friends, at its core, customer segmentation is simply the process of dividing customers into smaller groups based on things that they have in common. It could be age, gender, location, income, marital status, lifestyle. Friends, these are all factors a bank uses to understand who its customers are and, more importantly, what they actually need. Because here's the truth: a 22-year-old student in Mumbai does not need the same banking product as a 60-year-old retired teacher in some village of Bihar. Treating them the same way does not serve either of them equally well. Well, segmentation fixes all of that. It allows banks to speak to specific groups in ways that they actually resonate and relate to, using the right message, right channel, and of course the right product. Here there are 4 key segments in rural banking. In context of business correspondents and facilitators, the people who extend banking services into villages and remote areas, there are 4 main customer segments that matter the most. Now, let's meet them. First segment is the village. Friends, village banking is built on the idea of microfinance, that is, small financial services for people with small but real financial needs. It's administered locally, not centrally, and the business correspondent's job is to understand what each village actually needs. Is it saving products, remittances, small loans? And all this is brought to their doorstep, often through door-to-door visits and community gatherings. The second segment is remote areas. Yes, there are communities which are far away from urban centers, places that have limited transport, limited infrastructure, and very limited access to formal banking systems. For people here, a bank can feel something that exists in another world entirely. Here, business correspondents bridge the gap. They run awareness campaigns, explain financial products in simple and vernacular languages, and introduce services such as mobile banking, UPI, debit cards to the people who may be hearing about them for the very first time. Segment 3 is of housewives. Friends, this is the segment that is often underestimated and should not be done. Housewives manage household finances, making daily spending decisions, and in many cases, they are the primary financial planners to the complete family. Yet, historically, they had limited access to formal banking, often due to lack of awareness, not lack of need. Today, banks offer products which are specifically designed for women. A business correspondent working with this segment is not just opening accounts, they are opening new doors of opportunities. Segment 4 is for farmers. Farmers are the backbone of rural economy. A business correspondent working with farmers has to understand the agricultural cycle, when income comes in, when expenses peak, when a loan is needed, and when it can be repaid. They explain them products like Kisan credit cards, crop loans, agri insurance, etc. Now, there is a question: how actually banks reach these customers? So, we already know the segments, but how do banks actually reach them? There are three approaches here. First one is door-to-door calls. Exactly what it sounds like. The bank comes to you. Business correspondents visit homes, explain banking services on the doorstep, which helps customers make deposits and withdrawals without ever stepping into a branch. Second is community gatherings. Banks show up where people already are present. Local sports events, school camps, district level meetings, panchayat meetings, etc. A bank's presence at a community parade is just not a PR activity. Friends, it's a trust building exercise. It says, we are part of this community, we belong here, and we are your. And that familiarity makes people safe enough to walk in and do the transactions. Third one is campaigning. Banks run targeted marketing campaigns, which includes newspaper ads, TV spots, big hoardings, digital and print media. Each campaign has a specific goal. It could be launch a new product, boost adoption of existing product or service, or correct the damaged reputation. And the smartest campaigns are the ones that speak directly, heart to heart, to a segment. Not to everyone, but someone. So, here is the big takeaway from today. Customer segmentation is not about putting people in the boxes. It's about understanding them well enough to actually serve them. A farmer needs different things than a housewife. A remote area customer needs different outreach than a village customer. And when banks take the time to understand those differences and act on them positively, banking stops becoming intimidating and start becoming genuinely useful. That's what good banking sounds and looks like. And that's why the people working on the ground, the business correspondent, and the business facilitators are doing some of the most important work in financial inclusion mission. If this episode gave you something to think about, please consider sharing it with someone who could appreciate it. Every listen, every share can help build this community of knowledge which can grow further. This is banking for everyone. Until the next time we meet again, stay curious, stay informed, and do take care of your financial health. Thank you.